Good morning, everybody. April 3rd, 2023. We're ready to make some trades. Welcome to the stream. See you in just a second. What up, everybody? Good morning. All right. Hit that link in the dashboard. Bypass, just, I put a link in announcements for you guys to access the app if you're having trouble accessing the app. Feel free to, for a little bit, help share that around. They pushed a huge patch live this morning. So he usually does a pre-market check, and he hasn't done his pre-market check today to make sure everything's good. So he would have caught that. Our apologies. So just go ahead and go straight to the app. You can log in directly. You should be good. Market's opening. It's Monday. I have a solid case of the Mondays today. I'm a little scatterbrained, but let's get to it. How was everybody's weekend? Y'all do anything fun? I got my car washed and went to a spa. I was doing like adulting. Nice. Market's opening rational across the board. Partial caution, right? Yellow light on Nasdaq. We're kind of tapping that lower band. Trade small day already out the door. Below triple B on VIX. Pivot's going to be sharp. Looking good. Inside the band, I usually trade to the band. Whereas Nasdaq has already completed that puzzle. The band itself, while it is a pivot, the DD rule no longer applies. Of pivoting to the risk interval band or not. Still doing all the challenges. All the challenges. The The 10K to 100K challenge still going. It's at about 24K right now. The ETF doing the giving that a shot. Did 3 back-to-back evals, crushed all 3 of them for $550,000 worth of funded accounts. Keeping one of them to trade on stream. This is the funded version now, just detailing how you would maintain one of those and making a whole video series on how you can trade and pass those things. Or not pass, can't guarantee you can pass it, but how I pass it, maybe you can learn some wisdom from that or whatever. So, see how the market opens today. I think we open nice and clean. I think the market's been looking for a dip. The S&P is relatively flat from yesterday. Nasdaq's was trading down, so you have to watch our index divergence, irrational rule. We started the day just to see the two of them operating together. Hey, everyone, read announcements. If you don't read announcements in Discord, you're going to miss out on important information in Uriel. And read the chat here as well. Don't just come in and start asking me questions. You can scroll up and see people talking. You can go to the announcements and see it. You'll miss out if you're waiting for me, so. Yeah, no, I'm just saying for you. I'll always answer your question, but if you're waiting for me, you'll get the answer late. We'll always try to detail in the announcements anything that changed. I think I know what happened. The website itself, he's just going to push a button. It's going to turn back on. But you can bypass the website. There's a direct link to the app. You still have to log in, but the login will work. Yeah. My bad for you. My bad for her. We pushed an update live last night, which is pretty good. You ever index divergence alert? That's really nice to have. What up, guys? Let's talk about news coming out this morning. Sorry, a little shuffling today. Look at the economic calendar. All right, at the start of the day. Pop up today. Let's see. We have manufacturing PMI. That's going to be interesting. Construction spending also going to be interesting. ISM numbers. So we're going to have some catalysts coming through. I'm going to say. Then 30 minutes, that's going to be big movers on the market. I'm going to look for exact sharp pivots because we're below triple B. We're going to get those today. I'm not going to take any drastic moves out the open. I'm going to wait and be patient. Yep. Thanks for reminding me about that, Lee. You guys are good. Risk intervals unchanged. I don't know if the bot has changed them. If not, then they're unchanged. Can you guys hear me? Check. Okay. All right, 1 second. So I'm not going to do anything out the door. I'm actually going to take it easy. No trading out the door for me. I'm going to wait. We got those ISM numbers. We're going to keep it pretty clean. We can have the lower DD band on SPY, lower DD band on Russell. These are the things I'm looking for as interaction points, but clearly Nasdaq's already crashing down. I hate using the word. Trading down below its bottom risk interval. If we clear that and start trading lower, markets irrational and irrational. Just typically is like a no trade day. I'm going to keep it clean, keep it easy, not do anything out the door, and just wait for those numbers to come in. We got about 30 minutes. Going to chill. Market ups in a minute. Going to sit still. Just a little pre-market, kind of what we're watching today. You know, you have the PMI, and of course, the ISM numbers coming through, construction spending numbers. Those are gonna be the big movers. I think right out the door, I wouldn't put too much faith into anything that is seen as far as numbers go. And obviously, those are gonna be the big movers for the day. With the Nasdaq gapping down as much as it did, we're gonna be looking for index divergence between that and the S&P, just to indicate any sector rotating. I'll chime in with some numbers with where hedge pressures and such are for the open, and just when those numbers come through. But I would say that I wouldn't detect or want to predict anything until we get that bump from the news that comes out 15 and 30 minutes from now. But we're in the same boat that we were last Tuesday and last Wednesday, where Russell's trading up, the S&P's trading flat, and Nasdaq's trading down. It's just more sector rotating like we've seen before. People are pre-positioning, obviously, for a lot of stuff, you know, for this week and next. So I would say that's it. Go ahead. What's up? I'm still looking possibly for some longs whenever I get it. But mean reversion. So with S&P opening kind of like flat, we have on Rocket Scooter shows just a middle reverting. So we're kind of sitting there flat on that. Nasdaq, everything is just, nothing's coming out bullish or bearish today. So it's going to probably be a just kind of flat, choppy day, and it's going to kick off for the cows. So there's really no indication of anything moving right now on any of the indices. So things are just going to probably stay flat for the next 30 minutes. Okay, sorry guys, I'm on a podcast. It's Monday. You know how it goes. You know the drill. Abraham, Jace, everybody, go to the website. The announcements have the link you would use. And also, every time you come to the stream, you're always welcome to scroll up and chat. No, what I'm saying, Abraham, is if you scroll up in chat here or you go to the announcements, we gave you guys the answer, the solution. There's a link you type. Yeah, no problem. Always make sure you guys turn on the announcements in Discord. That's one of the first rules that we put in there in the read first. That's how we communicate to everybody. So if minimum you don't use Discord, you need to get in Discord. That way you can follow the announcements. You'll get the fastest news there because that's where we drop everything. Yeah, you have to use the direct link. So I'm not doing anything just yet. Right now I'm actually troubleshooting that one little spot on the site that was double checking. Nothing is, yeah, so I'm just taking it easy right now. Is DD correct? What do you mean is DD correct? How would it be incorrect? Just because it's really high, it is what it is, right? You guys are in for a treat with the DD at 98. Yeah, I'm not gonna do anything until the news comes out. Sure. Resilience kind of on the fence, flat near the middle, nothing going on. So all the stocks today are bullish, huh? Okay, nothing yet. Doing nothing yet. Dig the tunes. I know, right? I love like the lo-fi kind of chill music. I used to watch like Twitch streamers back in the day who would play like really intense video games with like chill lo-fi hip-hop music. I'm just gonna do nothing until the PMI numbers and stuff come out. We're gonna have to see how the market responds. There's really not a lot to say, but that GD is really good looking today. It's interesting to see. So let's run the scanner. So I'm not doing anything yet. I'm just gonna take it easy and wait. Can I check the liquidity map for Upstart? What do you want me to do? For look at it BSD. Let's do it. So when there's an event or a news event, what I like to do, especially for these kind of things right here, whenever you're doing these funded accounts, if everybody could smash that like button real quick, do me a favor, make that your morning chore. We're just kind of hanging out and listening to music right now. Give the algo some love. Leave a comment below on the stream, you know, do something like that. Give us a little algorithmic love. Every little bit helps. You guys are the best. So on liquidity maps here, like just right out the door, let me explain something about this. The whole funded account thing. The idea is you have to maintain and keep it. So, you know, you need to build some fat right out the door so you don't pass through. There's a static drawdown level on that. You don't want to go too far below it. So every day that I trade on this has to be a day I'm really sure about. When a news event's coming through, just don't trade in the news. Don't try to get a windfall up or down off the news. Just let it do its thing. Find a pivot and trade off of it when you get whatever you're doing. Whatever, if you're doing something like this, you have to know the rules. You have to set up the terms for each one of the account styles, and the technique you use for each one of them is completely different. You guys saw me do 2 150 static evals pass and then one 250,000 trailing drawdown pass, and I passed all 3 of them. The 2 150s, I traded 2 different strategies and they both worked. One of them was looser on risk management. The 250,000 was a completely different strategy than the 150 because they were two different styles. One of them had a trailing drawdown, one of them didn't, so I had to trade differently. So the rules for this one are I'm not going to do anything yet because there's a potential market catalyst, and I want to see the market dip to a level that I can buy off of. I only want to trade off of pivots right out the door just to build some fat in that account. You can't get below, you know, obviously the first 2 days were winning days. $1,300 is still not a lot of fat. I want to kind of be far enough ahead that 2 or 3 bad days don't draw me down to the stopping point. So I have to try to maintain this. Clearly trading in a catalyst is one thing I don't want to do. BSD around the door, right out the door. This one, resisting hedge pressure, which is that resistance that I'm seeing right here. Clearly what you're seeing, there's that kind of U-shaped move. U-shaped move. This is that potential move. If it starts trading below open, I'm very cautious in these BSDs as they fall down to the next resistance, wherever it may be. And you'd have to look to see where that is. Next resistance would be bottom of the bull zone. So upstart is kind of sandwiched right there for the moment. Oh shit, my bad. I gotta turn that back on. Why am I sitting here? Okay, thanks. My bad. Okay, upstart. My bad. Try one more time. So BSD, pull up the liquidity map, and the way I read it is open price. If market raises to hedge pressure, resistance back to open. It's upside down V. Are the pivots that I usually will see in a BSD, and there's that upside down V right here. Anything that starts trading below the open price, it falls to it can follow the next resistance. What I try to look for. Yeah, that's just save that link. Me too. BSD. You're trading below here. Okay, Roku. Okay, let me check it. So right here, trading below open falls to next resistance, and next resistance is the first thing you bump into, bottom of bull zone. So we're kind of sandwiched in there for now. Roku is what you're talking about now. Oh yeah, Roku from 65 to 63.5. I'm watching that right now. It's interesting to see these movers here, and I think let's check the news because it's now we just got the print. I think on the manufacturing PMI comes in 49.2 on a 49.3 forecast. So I think that's expectations are hit on that. I don't think that's going to be the mover today, but that is a pretty big. That is a. Oh, nice. Yeah, I agree. Watch and see how the market's responding to this manufacturing PMI. So the actual coming in slightly below the forecast. The actual itself also being probably not too far. I think it was 49.3. I'm looking at it from the last one on the 24th, which is just over like 2 weeks ago. I would say I wouldn't think this is going to catalyze the market or do anything from here. I don't see the market sped up for about a second or two and then slowed back down. I think with the bigger news coming through is going to be in about the next 13 minutes. You have the manufacturing, you have the ISM numbers coming out and the construction spending numbers. There's a little bit more data coming from all of that. So I think that's going to be the real mover of the market. But again, everything's looking pretty solid. It does nothing really scaring me. Resiliences are positive. DD's a high 9. So market's going to maintain bullishness. And with the S&P becoming that mean reverting level, we always try to, predict DD kind of like points to the bull zone. So we're clearly walking up to it right now. So that's good to see that the market's still trying to find its way higher. And this short squeeze is really powerful, the one that we all were talking about last week. Manufacturing news? Okay. So usually investing.com is a pretty good summary of what to look at. So it's a number that pivots 50. So anything above 50 is considering is constitutes expansion. Anything less than 50 is contraction. So it's a raw metric that you can use to measure company performance with. So they use these things for the most part when you're trading into earnings. These PMI numbers can help you see if certain sectors themselves are growing or shrinking. The factors that go into this, we'll kind of go back to the, so this is the manufacturing PMI and these are the ISM numbers. So let's go like PMI, this one here as well. A bit more detail here. For each, so the Institute of Supply Management Manufacturing Purchasing Managers Index report on business is based on data compiled from monthly replies to questions asked of purchasing and supply executives. So they're surveyed, they come through, and they indicate from different categories like how their company's performing ahead of time. Where are their new orders, their backlog, exports, imports, productions, the entire supply chain from how much raw material they have to how many orders they're getting to buy stuff. So it's to try to use like these data points to forecast productivity in that company. And of course, compared to the unemployment numbers that we've been seeing, people are still, can't get their jobs back or high continuing unemployment claims. Is that going to hurt forecasts on company growth? Was that efficient labor or inefficient labor that got fired? Right? If it's inefficient labor, you would see no change in the PMIs. You would see no change in what the forecast is in the health of the companies. PMI comes in relatively flat. A lot of people are laid off. It's still in the 49s. Not a terrible thing. So the ISM. So right here, you did reports compiled by two different groups. I typically have them like API and EIA for oil. One is a government group. The API is an institutional group based on actual industry folks. So the reports sometimes come in slightly different, but they're measured differently and probably ask different people. But the interesting thing to note is that throughout February, right, we've been sitting 46, 46, 47, 47, 49. That's growth. So the market the sector is growing. Manufacturing sector is growing, which is not a terrible thing. It's still not, or it's not growing. It's slowing down its decline. So I would say growing. The number is getting higher. Above 50 is growing. Below 50 means shrinking. So the shrinking effect is tapering up. So it's almost into a period of growth. There were times that we were in August of last year, right? The period we had a little expansion range and then contraction, then expansion. You're seeing waves of like supply shortages, which is probably what's causing this. You know, we've seen secondary and tertiary waves of supply shortages and transportation issues. Things in back order still can cause these expansion contraction waves, but that's ultimately rectifying itself. So we can trust from what we see as far as productivity goes, and the fact that layoffs are pretty much stopped at this time is that companies are just finding that equilibrium. So that as that number drifts towards 50, that's not a terrible thing. Being at 50 means you are not growing, you're not shrinking. It means you're balanced, right? So companies are looking to hire folks. The jolts are going up with the PMI numbers drifting towards 50 and higher, which means that they're expanding with the current employee base they have, which proves that they laid off inefficient folks that weren't doing anything. Does that make sense? So hopefully. The monthly maps, was that recorded? It's okay. Monthly maps will be coming out pretty soon. So don't worry about that. So the question is, the folks that we've been laying off, right? We got 8 minutes until the circus starts. So nothing happening yet. It's going to take it easy. We know how to trade these days, right? If I wouldn't be in a trade into a news event, DD big 90s, Bullstone is likely to hold, which is good. NASDAQ being the index that's below the rest of them will be the one that probably has the most to catch up to move to fill its gap. My cat's meowing. Our kitty cat is meowing. Hold on, I'm gonna shut that door. So if you go and look at the JOLTS report, companies are, well, actually, let me look at this week. Go to Thursday when they do these numbers come out. These are the two reports they're really showing you what layoffs look like. If you know how to read this, it's pretty simple. Walk you through real quick. So initial jobless claims are people that just got fired. They go file unemployment the first, like with literally you go to your car and fill out the form on your phone. And so like people are saying that people just don't hesitate on that. So this reflects layoffs with like a week or two delay at most, right? So people get laid off and within the week they filed. And you see the filings have become less and less and less severe. There's basically been 4 waves of layoffs since January of last year. Do we all see that? Make it a little bigger. So essentially, you know, we've had like 4 waves of layoffs and the initial jobless claims show that. And right now the continual jobless claims show that there's a big batch of people can't get their jobs back. So the idea is have the companies laid off inefficient or efficient labor. And this is a forecast into earnings. So if those PMI numbers come in pretty solid, despite the laid off folks who can't get their jobs back, which is the high bump in continual claims, it really shows that companies are going to be operating efficiently. And that would be perceived as very bullish for the market. Anything about 50 would be extremely bullish. Amidst the layoffs that we did see. So just keep in mind that number comes out in 5 minutes. And we just had the first number come through, the manufacturing PMI. So I got 49.2, which is at par on the forecast, but the ISM manufacturing PMI numbers estimate was 47.5. So if they come in anywhere higher than that, the market can respond fairly bullishly to that. At least all the stocks are positioned bullish for that. So Keep an eye out. 5 minutes, market's gonna start moving. Okay, so as this is flattening out, it means no new people are getting laid off. As this number right here, these are people that can't get their jobs back, that are continuing, they're still unemployed. Come on. Okay, that froze up. Yeah, whatever. My browser's frozen here. What a day. I love days like this. So right here, you see how, like, while people were getting laid off and those waves are going up and down, they were getting their jobs back relatively quickly, right? As this number goes up and stays up, though, these are people that are continuing to file unemployment. Essentially, you can see it as that. So these are the people that qualify for benefits. These are people that are enrolled in benefits and qualify. So these are people that are still receiving benefits or qualify. So that number is going up. It means there's people that don't have jobs. And the JOLTS numbers were also going up, which means jobs are being created. So companies, the PMI is going to prove that jobs creation means expansion, that companies are looking to hire people, and that the people that are wanting to get jobs, can't get the jobs, aren't getting it because they just want too high of a salary because of inflation. They're demanding that ridiculous post-COVID salary that they got, during an inflation period. They were getting $50,000, $100,000 raises and stuff to keep their jobs. And then they just got laid off. The company realized they don't need them. And then now they're like, well, I want that salary again. And they're not getting it. The companies have jobs available. There's workers available to fill it, and they're not connecting the two. So somebody's going to buckle in the middle. And the companies, if they need people bad enough, because those production numbers come in bullish and expansion, then the company will spend the money on the worker. If those numbers come in slow, then the company doesn't need the worker as bad as the JOLTS are. And we want to see the JOLTS come down and see the company are closing out those jobs, as opposed, and so they're only going to be creating jobs if they need them filled, and they're going to expand. You only create jobs when you're expanding. So the question is, do we lay off inefficient workers, or do we just lay off workers who want too much money for their salary? Either one of them, if the company brings them back and JOLTS come down, as unemployment numbers come down, that means expansion. PMI will hint at those numbers before they happen. So the PMI will tell you that people are going to get their jobs back and be hired, and companies will pay a little bit more, which will be perceived very knee-jerk as bearish, I would think, because if companies have to spend a little more money to get a worker in, that pulls their bottom line lower. Now, not saying that we're going to get bearish news today, but I think the PMI coming in really strong is a hint that the market may pop and then start selling because of that knee jerk. I'm trying to think 3 steps ahead. Okay, market's expanding. Now, generally that's bullish in the long haul, but I think the knee jerk will likely be bearish and say, oh, okay, companies need to fill those jobs. They're going to pay a little bit more money for the worker. And the workers aren't inefficient labor. They're actually efficient labor, just wants too much for the job. The other side of the coin is that the workers are just bad, and there's no available good workers, and companies can expand, even though they're getting a bunch of orders come through, and it looks like they can expand, but then they can't expand fast enough. They'll be limited by supply chain issues, manufacturing issues. If that's the case, then that will be perceived as bearish, straight up. So I would say that right now we're in a very weird, sticky situation where bad news is really bad, and good news is only slightly bad in the short term, and really good for the medium term. I love how you explained JOLTS and unemployment. Oh, thanks. I mean, the PMI is what you're using to forecast company earnings in that sector, right? You can see how companies manufacture anything. All right, we'll check really quick. DDs across the board, 90, 97, 93. And DD is now in the update. Does everybody see the DD number is now effectively updating correctly? Here we go. We got something going on. Here's the numbers. But DD is now in real time updating. You can see that it's 1% or so change. Okay, we got some shifting around here. The news came out. Let's see what we get on the reading. Came across the board. 49 to 46. Yeah, we're sitting at the PMI came in at 46.3 against a 47.5 forecast. Mostly new orders were down, and I think that was what I was forecasting to see. That means, essentially the market's not, there's some kind of bottleneck in production. I think it might be still supply shortages on the front end, but orders are coming down also because people are being laid off and companies are slowing down. And I think that's knee-jerk, probably not going to be seen as super bullish just for today. But in the long haul, it just shows that we're not in this massive expansion growth period, even though JOLTS are going up. Companies want to hire people, but looks like, you know, manufacturing clearly is slowing down. So there's a big disconnect in all the numbers right now. And curious to see how Wall Street perceives that. Interesting, right? Yeah, very bad data. Jaguar just said it. Don't like it. Don't like it at all. I mean, it just does not look good. Don't like it. I probably gonna avoid today. And again, I'm not gonna short or fade. Remember, no gambling here. That's not a gambling, you know, career that I have. I'm gonna trade what I like, and it just feels weird. Things feel off. Bullish data in the market. Kind of a weird report. I think that the perception is gonna be all over the place. It might be a day to not do much. Very nasty data. Let me analyze this really quick. Okay, what I'm going to say is that I'm willing to trade off of something for a reason to trade off of something. Now, the S&P with DD staying positive, we're going to likely stay or touch the bull side. We open bear, touch the bull. That's what DD typically implies. Again, you know, data, market's market. QQQ is bumping into an upper resistance of the bear zone. Very possible that we do trade down today. But again, no indication that's going to happen. I'd rather miss out and let it fall than short against a bunch of bull indicators, right? Resiliences are still positive. Clearly, the market can go higher before lower. So, you know, QQQ could fill the gap. Where do you think Tesla's going? I think Tesla's going to be responding to what happened in oil today. I think stocks like Tesla, even though they're trading down, there might be people that do pile into it. But in general, all the stocks today looks bullish still. Nothing looks bearish, even though the data's bad. The short squeeze power is real. I only want to trade off with something. Ideally today, I'd like to see the S&P pull back to like hedge pressure or something and take a dip. But my bot file was corrupt, so I couldn't run the bot this morning. I was scrambling to do that. Everything went wrong today, which is great. Website should be fixed now. Sorry about the inconvenience, you guys. They pushed a live update live this morning, and something was off on the website, but it's working now. Everybody has access to the app, right? Toss a yes in chat if you're good. You all good? Oh, good. Okay, good. I'm not fading any of this. Market's still strong. Resilience is getting stronger. Just interesting to see how that knee jerk played out. I'm going to pull the jolts up really quick. I just want to see something. Our cat is so funny. He can hang out as long as he isn't like chewing on the cables. You better be good, Fuki. Let's talk about some data real quick. Bullish numbers still. All right, let's chill on some economic data real quick. Let's have a fun 2-minute. So, as the so jolts are job openings that companies looking to fill the position on. Okay, one of the things you see, and inside of here, you can see that job openings. Right, we were post-COVID, right? People were opening jobs, come back to work, come back to work, come back to work. And people weren't filling in those jobs because of COVID. They didn't want to go back to work, or they wanted to stay home, or, you know, people were fearful of going to work, or companies opened the jobs where they found the employee. Either way, job openings that need to be filled, that's what that means. And then all through post-COVID, companies are like, come back to work, and then people started coming back to work. Oops. And so Now, as jolts are coming down, it means people are getting their jobs back. Remember those waves of layoffs that we had from January 2022 until now? Waves of layoffs. Oh my God. I love it. We have sound effects on the on the space. So now we have jolts pushing up higher, which can hint at expansion in the sector. Why would you have jobs with those numbers going up? Why would you open jobs that you need to hire people in, or maybe you fired people and you're trying to replace them in the jobs? That's the second way to interpret this. So, and as the layoffs have stopped, you can see that with this number. No new first-time unemployment. You can say no new recent layoffs in last since about January, right? It's about flat. So since about January, which is about here, those jolt numbers are up. It means people got laid off and the company is looking to replace them with a better worker. So companies looking for more efficient workers, which means they need people. I'll talk about that. All right. Lowest reading according to Jaguar since May of 2020. So let's talk about what we see. What we see, okay? So let's talk about a story. During COVID, right, everyone got laid off. Initial jobless claims, when you first get laid off, you filed. So jobless claims are going down, which means fewer people are getting fired and more people are going to work. Then waves of people getting fired, you know, the companies might lay off a lot. Like they hire way too many people, they pay them too much because of inflation. They need to start trimming a little bit more, and then now there's no more trimming. There's no more waves. So no more people are getting laid off. So the job pool has reached steady state. As people are getting their jobs back and getting fired and getting fired and getting fired, you see the continuous claims are going lower and flat, which means somebody got fired and immediately got a job within weeks, right? That's what this says. So you're turning people over. They weren't toxic workers. They weren't useless workers. They just wanted more money. And there was some company out there that was like, I'll take you. And then, of course, right about October of last year, right when the stock market bottomed out and started rallying, which is October of last year, you started seeing those continuous claims ramp up and up and up and up. So company, think about 3 waves, and then there was a 4th wave and we're done. At wave 3 and 4, those are the people that nobody wants to hire back. So what's weird, or those are the people, maybe waves 2 or 3, that nobody wants to hire back, right? So when the market was still good and everyone still needed workers, people jumped back into a job and they're great. Maybe they got fired again, who knows? But you can see that right here. We've laid off people to the point that now we're getting into some kind of standstill where you're laying off people that can't go back to work. Why? Do they want too much money for the job? That's either A, or B, they just weren't that good and nobody wants to hire them back because their skills don't match. Or sorry, they want to hire them back because they're not that great. They can't get a letter of recommendation. They were just that lazy person. Or B, it's skill mismatch. So what if the jobs needed are tech jobs or healthcare jobs or something? The person laid off is a teacher, right? The idea is that there could be a mismatch as well. But you see right now, there are a batch of people that need a job. A. This JOLTS number are the amount of jobs available. So the story that tells is layoffs have stopped at the beginning of this year because people can't get their jobs. Like, there's enough available workers out there. And as job openings are on the rise with no new layoffs, right, in the last 2 months, that implies the companies are creating new jobs. Like, if I lay someone off and I need to replace a new worker, then I created a job, and then that person I laid off would file unemployment. First time, that would go up. And the continuing unemployment, the guy that I hired back, that would come down. So you'd see that relationship, which we're not seeing. So really, this means companies are creating jobs. But there's people that need them. Why aren't they getting filled? So as long as the JOLTS are coming down, it means people are filling those jobs, right? And you can infer that from the numbers. No new jobless claims are released, so there's not a lot of people getting laid off, and you can just see that in the data. But the continuing unemployment claims are going up. So there's a disconnect. And the only disconnect I can think is salary. The companies don't want to pay what these people want to get paid. And also partial labor mismatch. It doesn't match the job that's needed. Not the right skill set or whatever. So these PMI numbers, if they're coming in very bad, right? So as that forecast, like what the supply chain is looking at, new orders, you know, shipping, raw material, all the things that they go into forecasting how well they're gonna, you know, how efficient they're gonna be and how smooth their lubricated their logistical chain is. If it's not, there's some kind of hiccup there, and the JOLTS are coming down, you're gonna have to ask yourself, you know, especially from that sector, is that real? Are people getting laid off because companies actually don't have the production to need them? They're not needed. So that means a slowdown. And that's the one thing we have to be careful about. So tomorrow's data is going to be even more important than today, according to this. This is one of the lowest PMIs we've seen in a long time. We haven't seen it this low since 2020. Today's reading of 46.3 is the lowest it's been since 2020. So this is just general slowdown for some reason, right? Imagine during COVID when production shut down to 0 and these numbers dropped. The weights are new orders, so how much do people want to buy your product? What you're able to produce, any bottlenecks in transportation of supplies, whether it's raw materials or even transportation shortages, would show up in the supplier deliveries and inventories. Do you have a stockpile of inventory to float for a little bit, both your input and your output, in case truckers can't get the stuff to you? Oh, well, we have enough to last for a month. If there's low inventory, the number comes, like all these things, and employment as well. Employment's also a piece of this number. So to find out what's really impacting this very low PMI number, Is it really because of the shortage of workers, right? JOLTS available and people need jobs. We're not hiring them. So is it because we don't have the employees to boost? Well, the number's been coming down for 2 years as we've been laying people off. So what it means is you had non-essential people in the ranks, right? Probably overproduced, and now we're stabilizing. Hired all these people, paid them all this money. Now we realize we don't need them. Let's lay them off. And this is coming down to reflect, you know, that initial year plus of layoffs. But I think that this is not easily seen, or this doesn't easily see the bigger issues as well. There's also inflation. Those numbers have been coming down since for a year. Another thing is that people that are laid off don't spend money as quickly. So the output portion of this, new orders, could be coming down, as if you're unemployed, you're not out there spending money as quickly. So consumer spending could be down, right? Rate hikes were high. Credit's tightening up. It's harder to get a credit card. So people aren't getting credit cards and spending money as quickly as well, which can just be a general decline in the downside portion of this. The question that I have is, where's the bottleneck? Either A, we don't have the workers, which is evident that there's a disconnect there. So this could be a portion of the reason this has been coming down, but that's only evident here. That doesn't explain this, because companies weren't creating jobs. So right now companies are creating jobs or needing jobs filled right now. So it does tell me that the employment is a big part of that. They don't have the ability to produce what they need to produce because they don't have the workers to do it. And that's almost 50% of the number. And that could be what the PMI is saying. So if JOLTS come in even higher tomorrow than expected, that's really bullish. And I think that that's interesting to see, that the companies are just needing the workers. And it's, the question is, okay, so why aren't the workers getting filled now? Companies need them. They're not hiring them. Why not? And if it's because they want too much money and the company's just playing chicken with the workers, like, we'll hire you if you want less. Well, we'll only take the job to pay us more, right? There's that debate, I think. You just can't find somebody that doesn't want a lot of money for their job because they all went and bought houses and cars and stuff during COVID, and they need higher salaries because of inflation. And this is inflation decline world. So I think that's a big portion of that bottleneck. And that's always been my thesis. And the companies are going to need the workers. They're going to be the ones that budge. But if you want 100K for your job and you want 200K for your job and they want to hire someone at 100 and they're waiting for that person to pop up in the job market, they're going to meet in the middle for sure. Companies will pay more than they want to if they're trying to hire people. That's always the case. Anyone has a job, you know that. When you put out a resume and you get calls from 3 different companies, you know you can battle salaries against them and get a higher salary than you initially wanted. It's just the demand. So the supply of laborers are high. The demand for workers is high. Someone's got to budge. So I think that might be the case. And again, I look at the grocery store. I don't see many supply shortages anymore. Resiliences are positive, which means type 2 resilience, where we are outside of the redistribution zone. Supporting at the close is likely where we are. It's a bull long up in SPY. Let me run monthly walls really quick just to see. Anything here? Show me any kind of resistances? No. Let's look at QQQ. That's one that hasn't moved yet. And QQQ is a pretty strong read today. Russell looking great. There are no flags. I can see anything here. Everything's still looking good. I don't know. So ideally what I'd like to see, because I'm going to be sitting out, is to watch Nasdaq pull back for whatever reason. But with resilience being so high, it's not going to want to do that. So I think the market's still going to push a little higher. There is no evidence of any selling, no shorting, like clearly Market's drifting up. So the question is, what's causing the slowdown? There's a slowdown just there because companies have been laying off essential workers, people essential to production and transportation. Like, oh crap, we laid off people too quick. Well, they did stop laying people off. Maybe that is why we're seeing what we're seeing, right? First time unemployment claims are down and not showing waves of layoffs, companies might have over laid off. They laid off more than what they wanted to, which could be a good thing. But nothing at this moment is really giving me any. So who's the question is who's going to move first, and we're going to forecast what that looks like. Companies need jobs and workers are available. Companies will just have to pay more than they wanted. They just laid a bunch of people off, so they're probably being timid, waiting for that perfect opportunity. But given enough time, if their new orders are up and they have jobs available, they need to hire people to produce them. So they will bring people in a higher salary, which is slightly bearish for the first quarter and bullish for the longer term. Simply, you think that if a company, right now people are expecting companies to pay a certain amount for jobs, and if they're just hiring people back at a higher than salary than you wanted, then the bottom line comes down a little bit. But then the bullish side of that is that, well, you're hiring because production's up. They'll offset that with more profit. And so you get back to the same debate we've had for the last 2 years. It's all about margins. What does it cost to produce something? And is that going to build its way into the price of something, which is the inflationary world we live in? So the whole talk, if you guys didn't cue into what I'm talking about, it's all about trying to predict what inflation's looking like. If you have to bring in more people at a higher price than you wanted to produce the same goods because orders are up, then the price of the goods have to go up and inflation turns around and goes up. The inflation number's coming down and implies that people are not, that the cost of making something is not as expensive as it used to be. So I think it's just a residual wave of companies laid off those highest paid Zoom call, chime in once a week employees. And they still want that salary, and they're going to sit there on their past due mortgage after 2 or 3 months and then finally buckle for less salary and have to bite the bullet. But that's just my thought. It takes a couple of cycles. Put yourself in that person's shoes. You and your spouse thought was, oh, house prices are going up. We got to get a house. It's a buyer's market. Houses are up 20%. We can double our money. Let's go get one. Oh, the house we want. It's a $700,000 house, and it's $900,000. We better get it for. It's $1.5 million. Let's go and buy it. And you buy a house you can't afford, and then you just got laid off, and now you're stuck. You need to pay your bills, and you probably still want that high salary you were getting because your company was throwing money at you not to quit your job during COVID. Right, they needed you. They need to keep the doors open, but then they put too much money in your pocket and realize you really weren't coming to work. You're just sitting at home and chiming into a Zoom call. They realize they didn't need you for that salary. Let you go. And you're 2-3 months behind on your mortgage. You need a job, which is where we are right now. How long until people buckle and want just enough money to pay the bills? Because they're desperate. The company is playing chicken with the workers right now. That's exactly what you see. You like my thesis? Oh, well, thanks. I mean, why would JOLTS be up with PMI down? It makes 0 sense. That is a huge disconnect. Huge. Why would you be creating jobs if your sector, or if, and again, this is manufacturing. Okay. It's not the entire market. So it shows that at least now we have the other, right? You have the other PMI. Which day that is. Where's the non-manufacturing? There we go. It's Wednesday. So it could be that it's not in the manufacturing sector. Right. So non-manufacturing activity, we'll have to look at that. And of course, down here, you can see all the different pieces of this. The new orders are down. That's a huge deal. The employment is down. That's a huge deal. So that supports the two things we were saying, right? So when you dig through the report, you can see what these things mean. Companies Yeah, I think that we're still trading higher today. I don't really see any downside, but it's just the crappy thing is there's no pivot to trade off of now. It's just been a gamble on the response to the report. I'm probably just happier than I'm sitting out doing nothing. So the employment is down. That the overall, and at least the manufacturing sector, the employment number just kind of drifting down reflects those waves of layoffs, getting jobs back, layoffs, getting jobs, because people are like shuffling workers around and see, you know, but clearly that's coming down to reflect the unemployed people. You would expect that number to be low. The number's very low at 46. Okay, it's very, very low. It hasn't been that way in a while. So you're having a lot of unemployed folks that can't get jobs back, and companies need the jobs. But the new orders being down forecasts worsening conditions. Okay, we did have a really lovely bump last month. The new orders being down clearly reflects the fact that those unemployed people are not out there spending money and getting credit cards to buy stuff. And companies that buy what's being manufactured as their raw materials for their production also down. Consumer spending should be lower. With inflation coming down, the only reason people are spending less money, all things being considered, is they have less money to spend. Which means clearly tightening credit, big part of that. And of course, when you're unemployed, you're now out there buying new iPhones. Okay, so that's the reflection of the pure, that's a pure bearish, actually very bearish number for the economy. Now, it doesn't mean the market's going to become bearish. Remember, we're sitting on top of the even more confusing thing is a setup for one of the biggest short squeezes we've seen in a couple of years. Ashton, we were talking with some colleagues of ours, John Carter and Ashton. Both are making posts about this. I've quoted both of them and what they've been sharing about the options market and the way options are spread out and risk is spread. Of course, committed traders, what we look at, the TFF report, it's all showing that despite bad economic conditions, short squeeze is still on the table, which is what you're seeing. UPS negotiation starting with the union, looking like UPS workers could be striking on August 1st. Ooh. That's exactly kind of like the metrics I was talking about. People want more money for the job they're going to do to reflect the inflation or the rates that are locked in on for a house or whatever they're paying for in their life. People are not getting paid enough to live on. Huge disconnect. Again, putting all the fundamentals together is very bearish. Just nothing good about any of these numbers. They're actually horrible. This actually spread. It's actually scaring me. And I don't really get bearish that often. Market moves because market has mechanics that doesn't care about fundamentals on the spot. It's just to note that there's a general contraction in the manufacturing sector, and it's clearly seen because people aren't the downside, new orders. I would say that the inventories probably would be going up if they're stockpiling them. They can't sell stuff fast enough, or the production, the supply doesn't meet the supply outweighs the demand. And that could be another reason that you see inflation numbers coming down, right? If you overproduce goods, supply outpaces demand, prices also come down. With inflation coming down, you can see that reflected there. And so that would just make a lot of sense. There's a lot of unemployed people not out there buying new TVs from Costco. Until prices come down far enough that they can afford them. So it's just a state of inflation. So yeah, I don't like it. Rocket Scooter is the GOAT. The levels do not lie. And the levels don't lie either, yeah. People are positioned for whatever they believe they need to position on. In the short term, I mean, there's so many competing fundamentals. It's all about time frames now. And typically, if you want to know what time frames matter, stocks trade quarter to quarter, right? Leading into earnings season, right? What does this data mean for this round of earnings reports? Companies, there are people that have been immediately laid off, right? that reflection of their productivity will come months later. So this quarter, this report, things are going to look great on paper. So you laid off a bunch of people and you had a stockpile of inventory. Imagine this. Imagine you made all this stuff. Clearly you can't sell it fast enough. Prices are coming down. And you just laid off 10% of your workforce. Your bottom line looks amazing. You have all this cheaply made stuff that's sitting in your inventory and you can float off your inventory for a while. And you just laid off a bunch of people. And now you have all this free cash to invest in your own company. That free cash flow and that forward guidance looks great. And the companies are going to look very bullish on paper with the last batch of data. And then if these people that just got laid off really are hurting the productivity of the company they did work for, and of course they're not spending money buying someone else's productivity, its next quarter is going to be bearish. That kind of puts a time frame on the short squeeze and still strengthens the thesis that we are stuck in the middle in the stock market and going nowhere. There's nothing hyper bearish and hyper bullish. It's just residual waves post COVID. There's, you overhired and you had to fire, you overfired, now you have to hire. It just has to stabilize. It's the oscillatory, you know, behavior of finding equilibrium. Yeah, it's chilling. Gotta love days like this. All right, let's talk about the new features. We had a new release today in Rocket Scooter. Your save window states are going to reflect like what you have open and not open, like here. It's just a little cosmetic change in your main window. The next release is going to let you pop out charts by themselves without the extra panels. The DD calculation now updates correctly. It was always correct. It just didn't update correctly. And it was less than a couple % error, as you see. It really wasn't enough to scare trading decisions. So, but it was definitely important to make sure it is real-time updating. So what happened was it was freezing, and we found the process that was causing it to freeze. So it would freeze at a certain point and no longer update. But you see the changes are a couple %. It's less than 5%. So unless it was at 50, it never was a problem. Because even at 50, you know, I look for 60-40 anyways. I need 10% variance, and again, this is well within the range of that. So anyways, DD updates in real time. It's perfect and works perfectly great now. And the updates are in real time every 2 seconds. You can now expand vertically the window, so you can now make this really big. There's now space on the right side so that you don't see that the effect of that right here. Let's just keep doing that. See right here? Wait, no. You see this guy right here? So you get that. You're able to resize those windows. That's also great. You can put these anywhere you want. These are the ones I use when I'm trading with. So, so that right margin there is really nice. And it floats to the right. So that way you don't... What happens is it would... Like the numbers on the right print whatever the last printed value is in this this display, and these are the actual real last value of the indicator. So as you move here, right, the number to the right just shows you where you are on the chart. It's designed that way so that you can see, okay, what was the number at exactly this time? Okay, but it wasn't scrolling, so now it auto scrolls to put some fat in there so that you can actually see what the last value is. If it was just stuck where it was, you might accidentally look at the wrong numbers. So we have auto scrolling now on these charts. There's a little cosmetic feature. We fixed some of the error messages that come through. Like whenever you get logged out, sometimes it'll say you get like 4 or 5 error messages as each one of your WebSockets closes out. We have different WebSocket connections to this platform for different feeds, right? You subscribe to different feeds from our server. And so anytime like it would, you know, we would update or you have to kick out, you have to like cycle through like each one of the error messages, like, you know, scanner feed down, candle feed that you, so we consolidated it into one message. We have index divergence now as an unusual rule. This is our, if one index resilience is greater than 10, greater than or equal to 10, and one of them is less than or equal to 10, the divergence will flag yellow. That's one of the neat things that'll show extreme amounts of sector cycling. And yeah, we pump that out pretty quick. That's ready to go. So that's there. Another thing is that sometimes when you would display, like right here, if you refresh and your drawings don't show up, we let you know to go to display. No toggles in display are selected, so it reminds you, oh, that's why. So you don't send, a lot of people are sending in tickers or tickets to tech support because, and I was actually one of them. And this was like, okay, if I'm being fooled by this, then okay. Because like when I teach and I demo this, sometimes I turn these off and I forget about it. And I come back the next day and I'm like, oh crap, where's my liquidity maps? What the hell? And so if you refresh and you have nothing selected, there's now an error message that will remind you that you turn all your drawings off manually, just to kind of hint at that. And that's it. And we fixed a lot of stuff on the website, which had to do with user accounts and like stuff that you guys just like to subscription maintenance and things like that, reporting mechanisms, or our team metrics, a bunch of stuff y'all don't care about. Oh, clicking a ticker in a scanner. It's right here. When you click a ticker, it opens up the chart. When you, we call these, you know, parent and child windows. So you open a child version of the instance. When you click on this, it now always opens in the master chart no matter what. So we don't have a grouping feature to like, if I were to take a new scanner instance and I pop out the new chart, which chart does this scanner interact with? So right now, everything defaults to interacting with the parent, no matter what you pop out. So anything I pop out should interact with the parent when you're done. Down the road, we'll have a grouping feature. I think your Slim has something like that, where I could assign a scanner and a chart and a watch list, whatever, to group 1, and they all interact with each other in group 1, and I can assign some to group 2, they all interact. That grouping thing is gonna come out later. Until the grouping thing is done, we fixed a bug that essentially if you open up a bunch of platform instances, which was like the pop-up, we've removed, here it is right here. Oh wait, they did put that in there, hold on. Well, here's how little I know. I didn't read far enough down the list. You can pop out a chart by itself already. Look at that. Okay, so that looks like they did release that. There it is. I was like, well, whenever they do that, this will be, oh wait, they already did it. Okay, so that's out. So now if you open up separate instances of the chart, and again, let's double check it's working. This would interact with the last open instance. So if you open up side charts, it would interact like that. But as you clearly see, like any version of the scanner interacts with the parent chart no matter what, which is good. So that's been released. Wow, they've done a lot in this patch. Good deal. Oh, and there was a fix on the Light app for the liquidity maps. They were also delayed on their updates in the similar process that the D ratio was delayed on its updates. And we fixed that as well. So at some point, the classic app stopped updating the liquidity map letters. That's been fixed as well. So all these real-time processes, so we fixed all that, which is great. Okay, market's moving, interesting. Let's take a look at this. I like what I see. So let's take a look. While market's pulling back, keep an eye on resilience. Nothing's irrational just yet. Everything looks great across the board. Perfectly nice and green. Honestly, I don't know what to think if we do end up here. Res stays positive. I'd be willing to take a long off of something. I just don't know what I want to take a long off of. Let's take a look at QQQ really quick. And again, hitting a bare wall on Qs is that resistance we talked about this morning. And put my DD bands up here. There's just not a lot think I'm glad I'm sitting out today, to be honest. We're talking about our Disney trip right now. So we're gonna be going to Disney World for our like yearly, like we're like every year, let's do something fun like a Disney World, right? A yearly theme park trip. So we're actually planning out a Disney World, Universal Studios, the whole Florida experience. I'm gonna come back with so many Legos and lightsabers, you have no idea. I have Darth Vader mask and we walk around the park looking like a 12-year-old. I know, Brian, we need to make like a friends trip, dude. All of us need to go somewhere. Get the crew out. Dave just went to Sun Valley, go skiing. We should have gone in Idaho. That would have been a hell of a good trip. We need to plan that next year. We need to make a ski trip next year for all of us. We should all go. Yeah, so no trades today. This is a clean, easy decision I made. I know right out the door. I have a mixed feeling about the economic data, and if you were to tell me which way the market's still going, it's still going to go bullish. I think today there's really no evidence of it finding any steam until it bounces off of something or moves off of something. We are going to likely support at the bull zone. We're likely going to support anywhere down inside of here. This is likely a new entry point for a possible long. I'm just not going to take it. I'd rather miss out. Let the market stabilize today. We have jolts coming out. We have non-manufacturing PMI. Those are going to be bigger movers, and so we got to pay attention to that. Let the market digest this. Let it digest the oil prices. It's a 4-day week, so it's going to be volatile. Let's let that volatility play out. I'd love to see, honestly, I'd rather see today collapse and then tomorrow, Wednesday, Thursday, rally back up. So, you know, oops. So no trade today, which is great, right? Russell pulling back a little bit. Let me chime in on this podcast. Hey, just chiming in on, I don't know if anybody's doing anything. I haven't made a trade at all today. I think that the idea that we had that partial irrational, scare on NASDAQ, and then the ISM manufacturing numbers come out, and everything looks really bad there. I've been chewing on the fundamental data all morning. It's kind of a mixed bag. There's a whole bunch of reasons things are just kind of not moving, and I think we have more important numbers coming out tomorrow Wednesday. The non-manufacturing data comes out, the jolts come out. That's gonna be a real telltale sign, and a 4-day week, right? So volatile markets. I haven't pulled the trigger on anything. Honestly, resiliences are strong. You heard Alejandro say that. DD is strong. Market does look strong. There's just nothing that I see to long off of. Like, I always wait for a good entry point, especially like in modes like this where the market has just got clean, bullish data on the surface, and then bearish news that just came out. It's always contradictory, and it's hard to see how the market's gonna work. So what I'm saying is I'm just sitting out and seeing if the market does pull back a little bit and resumes its short squeeze tomorrow, because all those short squeeze data points we've been looking at, like committed traders, the large amount of put to call ratio is really high, of course, like in the indices, and you're looking at all this recipe for a big short squeeze. I think that with oil prices gapping up, and the PMI data, as Jaguar said this morning, I mean, so we haven't seen that in like years, right? And the jobs, the employment number is really bad, and in the new orders number is both really bad, and that does show genuine slowdown. And these unemployed people were actually more essential than we thought. So the idea is that the question is, how does Wall Street digest that? Is this round of earnings going to reflect that, or next round of earnings going to reflect that? You laid off a bunch of people, your bottom line looks great this time on paper, next time maybe it doesn't. So Wall Street's got, it's a timing thing, like how far out of the projections in this bad economic data is that going to be reflected in Q1? I don't think so, right? And so I think the short squeeze still can overpower these bad fundamentals. So it's all these weird markets pulling all directions, right? And so it just strengthens the thesis that we're not crashing and not selling or not rallying either. We're going to sit flat. And I think that, I'm just looking for something to long off of still until I see evidence of the markets turning around. But I'm not going to make any trades today. I think I built myself into a thesis to kind of sit on the sidelines and look for individual stocks that are going to move. And other than that, that's what I think. What's up, Alejandro? You nailed it. So mean reversion means you're in between a bull and a bear zone. Markets are liquid, not bullish, not bearish. That DD number does pivot the SPY from that middle range to the bull side, as you correctly said. Out the door, I almost always trade out the door with strong resilience and strong DD. The only reason I didn't today was because I knew we had a news event coming out within 15 minutes of market open. So I don't particularly trade into an event like that, but the correct way to scalp would be exactly what you said. All signs pointed up, long to the bull side. So that what that indicates is that with DD being very strong, the SM, that's what you break a tiebreaker in mean reversion with, is that DD number. If it's greater than 50 in a rational market, it's bullish. If it's greater than 60, it's very bullish. So being 90s, extremely bullish, and we push to the bull zone. But the trick is that you look at anything in all the indices. Are there resistances anywhere? And the NASDAQ had a put wall it just bumped into. So I usually put NASDAQ, Russell, and S&P side by side. And the first one that hits a resistance typically can pivot all of them. When we started selling off, NASDAQ hit a put wall. You can see it on the Qs. So the correct trade that I take in that instance is I'll take the scalp on DD and close out when any of the indices bump into something and call it a day, or close out before a news event, which is like what you see now. So there, the SPY doesn't have any resistance that looked like it bumped into, but you can clearly see the NASDAQ did. And then of course you don't want to, I always think it's silly to hold a big position through a report with the variability you can get with how the market behaves after that. Is just gambling at that point. So yeah, I would have longed and strong and probably just trimmed minutes before the report came out, or trimmed at the put wall. Either one is great, but you nailed it. MRs are broken or tie broken with that DD number, and it's the first move that typically counts. So right now, as the market's pulling back, I'm going to look for something to long off of later if I find something. But now it's still just a remnant of the news that came out. So it could be It could be really bad. I'm looking at hedge pressures now just to see, but you see, you have to clear through all this noise to get down there. It just doesn't look clean at this point. That's kind of why I didn't do anything. And this morning, I would have taken that long normally, but because of the news report, I didn't. Glad I'm sitting out. What? The bull zone, it's not bull zone to hold. So what resilience does, I mean, what DD does is it says that wherever you open, like if you open in the bear zone, SPY is likely to stay in the bear zone a high percent of the time. If you open the bull zone, SPY likely holds in the bull zone high percent of the time. If you're in the middle, DD can tilt the scale, which it did, and then a news event is now changing the direction. So the news event is shifting sentiment. So you don't expect the bull zone to hold on a potential catalyst, which is what we're seeing. This is news event driven. Had there been no PMI today, right? No manufacturing PMI, this would have likely held, which is why I sat out. So I did detail I'm not going to take the trade because now we're in a potential run off of this news event, right? But all saying that if you were to take a bet which way the S&P closes bullish, it can close in a bull zone. But the problem is there are two bull zones. Which one is it? You have to keep that in mind. We open here in this illiquidity pocket. So this can be the bull zone that holds nom nom. Does that make sense? It doesn't, bull zone just doesn't mean it goes up. It does imply that it should go up if all the other stocks are in their bull zone. But if all the other stocks are in their bull zone because they gapped up and they're trading down the bottom, well, the S&P has two bull zones to choose from. You tell yourself it's going to like being in a bull zone, which now has two possible outcomes. Number one is it can either go there or it can fall to there. It's very rare that you're going to see bull bear like this all the time. This is not normal. So if it does fall through here, that could be the bull zone that holds. And this is an illiquidity pocket. And the fact is that since resilience is so, you know, essentially we're kind of heading towards zero. If this does fall, can fall really quick. I would be very willing to scoop up right here to scalp back to there. If I were to find a scalp. So it does mean that SPY is going to want to match what the stocks are doing. Stocks in a bull zone. SPY is going to be in a bull zone. You got two to choose from. So now you have a bottom to look for. 408 could be the bottom today. It's a kind of a rare effect. I don't have a lot of data points for it, but you ever seeing Nasdaq's irrational now? It's just not a good day to trade. And boy, oh boy, did I sit down on that when it's always good to be ahead of stuff, right? Y'all see me lose three trading days in the last 3 months. I don't trade unless I'm sure. That's how I keep my win rate high. That's how I keep control of my trading account. That's how I manage risk. You always have to wake up, be ahead of your news reports, know what's coming out, know when things are coming out, know when earnings season is. Pay attention to any breaking news events. And build stronger fundamental thesis. I'd like to see today pull back to that bull zone. Could be a scalp potential there if resilience doesn't look too bad. But all right, you may go to Phoenix or Vegas over Memorial Day. Ooh, those sound fun. All right, y'all. Everyone head to Discord. I'm gonna head on over there. Call it a day. No trades today. Good deal. Glad I set out. Market went up, came straight down. Nothing doing. No loss. Always a good thing. Everyone check out Rock Scooter today. What am I eating? Am I eating so loud? My bad. A Jimmy Dean breakfast sandwich. The worst possible thing that tastes amazing. I love these things. Terrible for my blood pressure though. All right. Go to Rocket Scooter. Check out the extended trial. $35 a month for our $199 a month package. Limited time only. And as soon as you guys enter that, You'll get to have every experience we have here. The entire boot camp. We're starting over today. Oh, I forgot to say that. We're starting our boot camp today. Starting all the training from day one. Everybody needs to come. We're going to refilm all the videos. Refilm all the videos. Make them shorter. Make them better. Do not miss out. This is going to be an awesome day. Promise. Everybody there, check it out. You can come to the entire boot camp for 3 months, $35. You're not gonna hate that decision, I promise. Okay.